What if I told you the stock market isn't just for the rich, it's for you too? Think it's only a game for billionaires? Think again. Every single day, regular people just like you are buying, selling, and making money in the stock market. But how does it all work? Is it just a series of random numbers, or is there a logical system anyone can understand? Stick with me, and I'll break it all down in the simplest way possible. No jargon, no confusion. Ready to understand how the stock market works and how you can be a part of it? Let's dive in. Step 1. What is the stock market? At its core, the stock market is simply a place where people buy and sell ownership in companies. Think of it like a giant marketplace, except instead of people selling fruits or clothes, they're trading shares, small ownership pieces of companies like Apple, Google, or Tesla. Here's how it works. Companies sell shares to raise money for expansion, research, or new products. Investors like you buy those shares, hoping they'll increase in value over time. If the company does well, more people want its stock, and the price goes up. If the company struggles, fewer people want it, and the price drops. It's kind of like an auction. Buyers place bids, sellers set prices, and when the two match, a trade happens. But here's the real question. Who decides these prices? Why do they change every second? That's what we'll uncover in the next section. Step 2. How do stocks work? Now that you know the stock market is a place where people buy and sell shares, let's take a closer look at what a stock actually is. A stock is a small piece of a company. When you own a stock, you own a tiny part of that business. If the company grows and makes more money, the value of your stock usually goes up. If the company faces challenges, the stock price can drop. Let's put it like this. Imagine you own a slice of pizza from a popular pizza shop. If the shop becomes super popular, more people want a slice, so your slice becomes more valuable. But if the shop loses customers, your slice isn't worth as much. Here's what happens when you buy a stock. You become a partial owner of the company. If the company performs well, your stock's value goes up. Some companies even pay dividends, a share of their profits, to stockholders, which can be a nice bonus. But why do stock prices change so much each day? And who decides their value? The answer is simple: supply and demand. Let's dive into that in the next section. Step 3. What moves stock prices? Now you're probably wondering, why do stock prices fluctuate all the time? Is someone controlling it? The truth is, stock prices change based on supply and demand. Think of it like this. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. To explain it more simply, let me give you an analogy. Imagine there's a concert by a super popular artist, but there are only 1,000 tickets available. If millions of people want those tickets, the price will skyrocket because demand is higher than supply. But if no one's interested, the price drops because there's too much supply and not enough demand. It's the same with stocks, except instead of tickets, it's shares of companies, and instead of fans, it's investors. So what makes investors want to buy or sell a stock? Here are the main factors. Company performance. If a company is doing well, making profits and growing, more people want to invest. News and events. A bad earnings report, a lawsuit, or an economic downturn can cause stock prices to drop. Market trends. If the economy is booming, stocks tend to rise. If there's a recession, stocks often fall. By understanding these factors, you'll see that stock prices aren't just random. They move for logical reasons. And they aren't controlled by any one person. They're driven by the actions and decisions of millions of investors. Step 4. How do people make money in the stock market? So with stock prices always changing, how do investors actually make money? There are two main ways people profit from stocks. 1. Capital gains, buying low, selling high. This is the most common way. Investors buy a stock at a lower price and sell it later when the price goes up. Here's an example. You buy a stock for $50. A few months later, the stock price rises to $75. If you sell it, you make a $25 profit per share. It's like buying a limited edition sneaker at retail price and selling it later when demand is high. 2. Dividends, earning passive income. Some companies pay dividends, which are small payments made to stockholders, typically quarterly. These dividends are a share of the company's profits. For example, you own 100 shares of a company that pays $2 per share in dividends. You get $200 in passive income just for holding onto the stock. But here's the catch. Stock prices don't always go up. They can drop too. Not all companies pay dividends. And making money in the stock market isn't about luck. It requires patience, strategy, and research. Now that you've learned how people make money in the stock market, you might think you know it all. But there are still some common myths and misconceptions about investing that can trip up even the most well-intentioned beginners. In the next section, we'll debunk the biggest myths surrounding the stock market so you can navigate it with a clearer understanding and more confidence. Step 5. The biggest stock market myths. Even though the stock market plays a major role in the global economy, many people still don't fully understand it. Let's debunk some of the biggest myths about the stock market. Myth number 1. The stock market is just gambling. A lot of people think investing is the same as betting in a casino, but it's not. In gambling, the odds are against you. In the stock market, though, investing in strong companies over time has historically led to long-term growth. While there's always some risk, it's not about luck. It's about making informed decisions. Myth number 2. Only rich people can invest. Many believe you need millions to invest in the stock market, but today, anyone can start investing with just a few dollars. Thanks to fractional shares and index funds, you don't need a fortune to get started. Myth number 3. A stock's price shows its value. Just because a stock is expensive doesn't mean it's a good investment. Stock prices are influenced by supply and demand, but the true value of a company is determined by its financial health, growth potential, and position in the market. By understanding these myths, you can see the stock market for what it really is. A system based on logic and strategy, not luck or random chance. So that's how the stock market works. At its core, it's a marketplace where people buy and sell shares of companies. Stock prices rise and fall based on supply and demand, influenced by things like company performance, economic conditions, and investor sentiment. And to keep everything fair, regulatory bodies like the SEC monitor the market to ensure it runs smoothly. Now that you understand the basics, you don't have to feel confused when you hear about stock prices rising or falling. You know what's really happening behind the scenes, and you're one step closer to being able to make smart decisions when it comes to investing. If you found this video helpful, drop a comment below and let me know. And if you want to learn more about financial systems and investing, make sure to subscribe so you don't miss the next video. Thanks for watching, and I'll see you in the next one.